So when you think of equities, you think of wealth creation. When you think of debt, you should think of wealth protection. You know why Virat Kohli is so popular and famous? It's not just because of the runs he hits. It's not just because of the quantum or this. It's because he does a lot of ones and twos. I think one of the biggest drivers of this bond space has been the regulator themselves.
Yeah. If I am a 30-year-old looking for, diversifying my portfolio into debt, what's your recommendation?
The direction of FD rates as an investor is that it is going lower. So it's a good time to lock in rates at a higher rate that is available in the market today. What is not known is that the 5 lakh deposit scheme that we spoke about is equally applicable for a small finance bank as well as an HDFC. So your money is as safe in those banks, though you may not have heard of some of those names.
In a way, investing in the portfolio of bonds is helping me getting more liquidity.
More liquidity, possibly more safety, more professional fund manager, but lower returns. Because it's easy to be safe but not generate any returns.
Hi Vijay, welcome to Power Academy. It's so good to have you here. There's been always, buzz about equity and, with the whole bull spree, everyone wants to, sort of dip in their feet into equity for wealth creation. But equally important is debt to, have debt in anyone's portfolio. And we thought, let's sort of answer this question for our audience on the different asset classes within debt or fixed income instruments. And who better to talk about that than you, who has been in this industry for so long. So thank you so much for taking out the time. Let's get started right away. So Vijay, let's start with a little bit about your journey, your background. Could you share with our
Sure.
audience?
So right now I am CEO for InCred Money, and I'm a director at Bid, an online bond platform. Prior to this, I used to run my own startup called Oro Wealth. It was an RIA and in the mutual fund space, and we got acquired by InCred in late 2022. And after that, we formed InCred Money. And our aim with this is to build a leading alternate investment platform for retail and mass affluent users. Today, the name alternate is because debt is seen like an alternate. Bonds are seen as something that you add on to your core portfolio. However, debt instruments have always been there in the form of fixed deposits, which is a very famous product in India. But on InCred Money, we are pioneering a lot more on this side of products. So that's been in this avatar. Prior to Oro Wealth, I used to be an institutional trader. I used to work with L&T and be an investor in the markets. Always been on the investing side, and that's where Oro came very naturally to me. And now with InCred also, which also has the same DNA. Yeah, so that's been my professional experience of about 15 odd years.
Great, perfect. So you spoke about, having debt, and unfortunately people just think that equity is the only way to sort of create wealth, but a good portfolio is a diversified portfolio. So what's your take on, having the portfolio allocation? How should
Right.
that strategy be like?
So I always use this analogy when I do that. So you think of it like if you follow cricket, right? So you used to have this Fab Five, where you had Sehwag, you had Tendulkar, Dravid, Ganguly, and Lakshman, right? Very different styles of batting, but all essential to form a great team. So similarly, when you're investing, you need to build a portfolio that can be all weather, what I call, which can work in any market scenario. And that's where, having a debt in your portfolio really helps. So when you think of equities, you think of wealth creation. When you think of debt, you should think of wealth protection. And another example that I always give is, why Virat Kohli is so popular and famous? It's not just because of the runs he hits. It's not just because of the quantum or this. It's because he does a lot of ones and twos if you actually watch him bat. As a result, he is not under any pressure to hit boundaries. And that reduces. So you need to keep your portfolio ticking. You need to keep your scorecard ticking. That prevents you from taking needless risk, which people very underrated don't understand. So debt is very important from that angle. Another great diversifier is gold. So having a little bit of gold also in your portfolio helps. So it's very important to have that diversification. And finance theory says that if you do it, your overall outcome of a portfolio over a long period of time does very well. So debt plays a very essential role in that diversification.
Right. And on that note, wanted to know what's your portfolio like? How much is allocated to which asset class?
So see, as you know, coming from a startup ecosystem, typically we tend to be a bit more poor than the others until we have an IPO. But yeah, so I hold a lot of equity, private equity in the form of shares of the company. In addition of my liquid investable surplus, I have about 20-25% in debt. I have about 50 to 60% in equity and the rest in what I call alternates,
Okay.
which kind of boost the returns of the portfolio. So small amount over there. I hold debt mainly across bonds because they're more higher yielding. I personally don't invest too much in fixed deposits because it's a great product, but for a different risk profile. But yeah, this is it. And I think for my age and my goals that I have, I felt about 20-25% into debt is a fair allocation.
Right. Thanks for sharing that, Vijay. And I think let's get into, the key asset classes in debt right away. We'll talk about the four key asset classes, I would say. One is FD, another is bond, third is debt mutual funds, and then fourth is, a new category of alternate investments that are coming up. So let's, sort of
Sure.
go through them one by one. And let's start with FD, which is like India's favorite. What's your take on FD? Why does it still remain so popular in India?
Right. So FD market is very large. It's almost double the total mutual fund market in India. It's 128 lakh crore market.
Wow.
The reason for this is there is universal love and some characteristics of a typical FD product. One, very safe. It's pretty safe. It's got a guarantee by an RBI company called DICGC, which gives up to 5 lakh per PAN per bank. So you
Okay.
have that as a deposit guarantee. Second, very simple to understand. It's also linked to your bank account where most of your money already is. And third, it gives you systematic cash flows. So you know your money is going to come to you and it is safe. And in terms of emergency, you can also liquidate it at a cost. So some of these characteristics make it a great product. Maybe returns may not be as great as some of say equity market, but it has its own charm that I can understand why people do it. And primarily from a low risk, right? You
Right.
want a place where you can park your money safely. You trust your bank, and hence it works.
Right. Since you spoke about safety, right? So you said it's 5 lakh insurance per PAN per bank.
That's
So
right.
if I have an FD in two different banks, overall I get a 10 lakh
That's correct.
insurance.
Yes.
And
So if you in your family have two PANs, husband, wife, and you also want to do it on your child, then it's per bank you can do 15 lakh across three accounts.
okay.
But it's not just the FD, it's also the entire deposit. So if you have some money in your current account or in your savings account
Okay.
and your FD, so this plus this all total adds up to 5 lakh of guarantee that the
Okay.
government will do, that RBI will do if something happens to the bank.
Okay, understood. And in terms of returns, right, we often say that, FD doesn't beat inflation and so on and so forth. But there are small finance banks right now who are giving a quite good rate of interest. How do they manage to do that?
Now, banks like State Bank of India or an HDFC have a great brand and they're able to attract depositors at say 7%, which is sufficient for their business, and they don't need to offer higher rates because people are willing to invest at that. Whereas small finance banks it's a pretty new license, come in the last 10 years, new names. So there is an element of trust that people are yet to fully build on some of these banks. And as a result, if they have to attract a deposit away from an HDFC customer, then they need to offer that extra return. So that extra kicker of 2% returns gives small finance banks the ability to offer that higher rate. But what is not known is that the 5 lakh deposit scheme that we spoke about is equally equitable for a small finance bank as well as an HDFC. So your money is as safe in those banks, though you may not have heard of some of those names, but it's as safe. And hence they're able to offer it. And I think it's a welcome move because at 7%, you barely beat inflation. So you are where you are. But at 9%, it becomes a very compelling story for a fixed deposit or a low risk investor.
Right. And often we don't calculate, but 9% or 7% also after cutting tax should beat inflation. So I
Yes.
think that
Yeah, on a
math.
post tax basis, it becomes a lot more challenging. That's right.
Yes, yes. So I think 9% still gives the room to be at
Yes.
inflation post taxes
That's
at
right.
least.
That's right.
No, fair. Great. What's your take on, the future rates of FDs? Will they go up, down?
Right. So, if you want to determine the interest rates in the country, you need to look at how inflation is moving. And our rates also are little connected to what happens global rates, what happens in the US that the Fed does and all of it. So, because it is at an all-time high, I think the broad direction is that the rates will go down over some point of time, possibly in the next 12 months. As a result, your fixed deposit rates are also linked to it because when the RBI sets what is called a benchmark rate, which is known as the repo rate, both the rate at which banks lend money and the rate at which banks attract deposits are connected to it. When rates are cut, bank reduces the rate of deposits and they also reduce the rate of lending. So if you are a borrower from a bank, you want rates to be cut. But if you are an investor into the bank, which is a FD, you don't like rates to be cut because you're getting lower. So I think the direction of FD rates as an investor is that it is going lower. So it's a good time to lock in rates at a higher rate that is available in the market today. But with time, in about 12 months or so, I think rates will be lower than where you are.
Right, got it. I think with FDs, that's been the story and the charm. But when it comes to bonds, right, they are relatively more recent. Of course, there is some hype about it. Let's start with from the basics. Like, what exactly is a bond?
A bond is issued by a company or by the government or by anyone. You invest in a bond, essentially you're lending to the company. They pay you what is called coupon or interest periodically. That could be on a 6 monthly basis, it could be on a yearly basis. You have bonds which give you interest monthly. And after the end of the tenure of the bond, you get your entire principal back as well.
Okay. Would want to understand like what are the kind of interest rates that I can expect from each category? Could you tell more on
Right.
that, please?
So the first category is government bonds. So you can get around between 6 to 7.5% is the rate range,
Okay.
depending on the tenor. Typically, government bonds vary based on your maturity date. Short maturity are called T-bills. And then long maturity is, as I told you, a 40-year bond will give you the highest rate. In the government category, if I just go deeper, you also have what is central government, and then you have state government, and then you have PSU. So the rates vary according to the nature of protection. So central government bonds are the safest, and they offer the lowest rate. State government bonds offer a slightly higher rate, and the PSU bonds are an REC, a PFC, a HUDCO. These are the ones that offer a highest rate. But all of these are typically in the range of between 6 to 7.5%. Then you have got the private bonds. So private bonds vary from 7.5, 8%, right up to 20%, and it's a very wide range.
Okay.
Now, in that also you can determine based on the quality of the company. Tata and Reliance probably are in the 7.5, 8, 8.5 zone, and
Okay.
L&T. If you go to a Shriram Finance, that's at about 9%. A Muthoot Bond, a Manappuram, NBFCs, well known, branded, but not as much as say a tier one, blue chip company. So they are in the 9% order range. Then you come one step lower to NBFCs like a Kirtana FinServ, a Stash Fin, and so on, which are in the 12, 13, 14% range.
Okay.
So as you can make out, as you slightly don't recognize the name of the company, which means they're smaller in their stage, your rate tends to go higher. And then,
Got
of
it.
course, your fourth category, which is your very high yield junk bonds, there you can get up to 16 to 20%.
Understood. And in terms of where to get these from, so are there like government websites that I can like that I trust more? Can I buy the bonds from there?
Yeah. So for G6, there is a website that the RBI has put out. It's called RBI Retail Direct, and you can go over there and you can buy government securities.
Okay.
For all the private sector bonds, there are a lot of online platforms that are available.
So if I am a retail investor and I'm looking to, buy bonds, what should be my framework?
You have to look at 3, 4 parameters when evaluating bonds. First is one, why are you buying? So, what is your tenure of investment? You have different bonds that range from 1 year right all the way to 10 years. So, you have to determine what you want. The next is looking at the pedigree of the company, the brand of the company, or the brand of the promoter. So, either way that you do it, like whom are you giving your money to? Having the knowledge about the company really helps. And what is the kind of cash flow that you're expecting? So, some bonds give you back interest every month. So if you're a retiree, for example, you need that because you need money every month. But if you are, young and you can wait, you can do the other extreme, which is you pay at what is called bullet. You pay only at the end of maturity. They'll pay you the entire interest and the principal. So you don't get cash flows. These are some parameters you need to keep in mind.
Got it. Got it. So, how liquid are bonds? So, for example, if I take a bond that has, 1 year, tenure, but I need the money before that, can I resell it? How does the liquidity work
Right.
like?
So in bonds, actually, bonds is a very new market in India. Compare it with FD. FD, if you want to liquidate before your tenor, you pay a break cost and you get it. Typically around 1% or so you pay and you get it. In bonds, you have two types of bonds. You have what are called listed bonds, and then there are also players who offer unlisted bonds. So in unlisted, there is no market, so it's very hard to liquidate it. The main market is in the listed space. Listed bonds are listed on the stock exchange. However, there is not too much liquidity over there.
Okay.
So one of the drawbacks today of investing in bonds is that you don't find easy liquidity. That's one of the risks of investing in this product. And hence, you should plan your investment according to the tenor that you would want, and you should be prepared to wait.
Got it. And for my understanding, I was reading this news recently that SEBI is starting like a liquidity window for the bonds. Could you tell more on
So,
that? Yeah.
what SEBI has said is that in order to create liquidity, at the end of every year, me as the borrower can offer to buy my bond back. So, what that means is that you don't have to hold it for 3 years. Maybe 10%, I'll say that I'll buy back at the end of 1 year. I'll keep that option.
Okay.
You may still not want to liquidate because you
Mhm.
don't have that emergency that you probably may have had. So hence I'll keep it open. I may buy back the bond and you can sell it back to me and take your money back, even though you have invested for 3 years, but you can get your money back in a year.
Okay.
So they have given the flexibility for a borrower to have such clauses in the bond agreement that allow me to do buybacks at different time intervals during the tenor of the bond.
Okay. And is it specific to a particular borrower, say government or maybe the
No,
blue
they've
chip, or
given it to
everyone?
everybody. Yes, they've given it to everybody. They can choose to exercise it or not.
Okay. And as we are discussing, how bonds are now becoming increasingly attractive for retail investor, there was this recent another news by SEBI where they reduced the ticket size from 1
Right,
lakh to
right.
10,000. That also, I think, helps it
Right.
like people like me
Yes.
to sort of invest
Right.
because I don't want to lock in 1 lakh
Yeah, it's
directly.
actually a fantastic move. I think one of the biggest drivers of this bond space has been the regulator themselves.
Yeah.
Until 2022, this used to be minimum 10 lakh. From
Okay.
1st Jan 23, they brought it down to 1 lakh face value, which is the minimum ticket that you need to
Hmm.
invest. And now recently, they've also opened the option of minimum 10,000. So the reason why SEBI is taking baby steps, and very rightly so, is that it's a very new asset class. And people should understand the risks of every product that they invest in. Typically, in any bond, you have three types of risks that you should keep in mind. The first is called a credit risk. Credit risk means that the person whom you have lent your money to or the bond you have bought is not able to pay you the money back at the end of the period. Essentially, he's like shut down or defaulted or had some problem, which means you'll not get 100% of your money back. That is the biggest risk that bonds face. And for that, you need to gauge the ability of the borrower to pay your money back. It's called debt servicing ability. However, this is only for private bond issuances. You also have what are called public bond issuances. So when you are a public bond issuance, then the minimum goes down to as low as 1,000 rupees. While they have brought 10 lakh to 1 lakh and now 10,000, SEBI has also put a little more safeguard and eventually it will come down to 1,000 also in a few years. At which point the lines between public issuances and private will blur and everybody will follow that highest level of standard of issuances.
So, and even for 1,000 or 10,000, which is the minimum ticket size, as retail investors are getting into this, one thing to assess risk is the rating, which
Right.
usually CRISIL gives. You mentioned another metric, which is debt service,
Yes,
debt
yep.
serviceability. Could you talk, what are, say 2 or 3 metrics that a retail investor can look at while choosing a bond?
Right. First, credit risk. So, who is the borrower? And in terms of some numbers like what is their cash flow? Do they have the ability to generate cash back? So, for example, if you're investing in an infra bond, you need to be careful because they are long duration projects. But if it's say an FMCG company that was raising a bond or an IT company that's raising bond, they are a cash business. So they have the ability to pay you back. And this is called debt servicing ability.
Okay.
The second is the promoter. So often the promoter is key because there are some clauses in bonds where the promoter guarantees the issue. Suppose the company is not doing that well. The promoter can say that, okay, I will step in, I will repay the bond on your behalf. So sometimes they give those promoter guarantees. So they give those clauses. So that's also something that is a positive.
Okay.
The second risk that I spoke about was market risk. The market risk can be eliminated by buying short duration bonds, what means that you buy between 1 and 3 years. You don't wait for a 10-year bond.
Okay.
The third thing that they need to look at is they're called covenants. So covenants means paperwork of the issuer. So for
Okay.
example, if the credit rating of the issuer goes down, you automatically get a higher interest rate. So it also deters the borrower because the borrower wants to borrow at the lowest possible cost. And if I don't do my business very well, then I'll get downgraded. And if I do that, then my cost of borrowing goes up. It's good for the investor, but it also means you're
Risk.
taking a lot more risk. So looking at some of these covenants and doing very good paperwork, I think is essential. And it's also a challenge because retail investors don't understand a lot of this. And that's where the role of some of these online bond platforms, to answer an earlier question of yours, where can they do all this? So you can actually go to some of the platforms in the, that are available today and check out all these details that are summarized in a very nice, easy fashion for you to sift through. They should have the ability to do a bit of research before they buy these bonds.
Right, right, fair. Coming to taxation, so in FDs it's taxed as per our income tax slab. Is the same thing applicable for bonds as well?
Unfortunately, yes. There are two ways you make money in bonds. One is the interest that you periodically get. That is taxed at your income slab. The second way is that through the price movement, the capital appreciation that is there. In that, it is slabbed as per your capital gains. So, which is that in short term, it is marginal, and at long term, it is LTCG, which today is 12.5%. But most of the issuers issue at 100 and also redeem at 100. So, there is very less chance of any capital gains accruing in bond instruments unless you are trading it. And that is only done by the institutional market. For retail investors, that doesn't exist. So, pretty much your taxation is at your income slab level only.
Okay, got it. Great, Vijay. So we spoke so far about FDs, we spoke about bonds in depth. Now moving to the third asset class in debt or fixed income securities, which is debt mutual funds. Now there are n types of debt mutual funds. So just let's start with basics. A, what debt mutual funds are, and second, what are the kind of risk return that one can expect in them?
Just as in equity mutual funds, when you don't know which stock to buy, you give it to a mutual fund, a fund manager who decides for you. A debt mutual fund is exactly that. You give it to a debt fund manager who decides what bonds to buy on your behalf. And he charges a small fee, which is the expense ratio of the scheme. So, debt mutual fund is nothing but a fund that invests in bonds forward.
Okay, understood. And what is the range of returns that one can expect?
The range of returns is lesser than what you would do in bonds. So the range could be from 6% all the way up to 10-12%. And
Okay.
how does that be determined is that there are government mutual funds. So mutual funds, debt mutual funds that invest in government securities.
Okay.
Then there are funds that invest in private companies, and then there are funds that invest in high yield private companies.
Okay.
So the same thing is just a fund manager who does it, and you get the same set of rates. Mutual funds don't invest in the fourth category, the very high yield. So they kind of get capped out around 10-12%. So about a percent or two lesser than direct bonds is what you get here.
Got it.
Now, another way to determine different types of debt mutual funds is by the maturity
Right.
of the instrument. So you have sometimes, so when you give a loan to somebody for 1 week or 1 month, right? It's much smaller than a year that normally bonds are. So these are called short term funds, which means that they invest in short term debt. You also have a fund called overnight fund. So it is for end users overnight borrowing,
Okay.
typically done by banks. So they want to borrow to manage their liquidity between the loans on any given day. And hence those funds are called overnight funds. So it starts from 1 night to 7 days. The 7 day one is called liquid funds. As the name suggests, it's fairly liquid. So you'll get your money back and invested in liquid instruments. Now you have to remember that when you invest in debt mutual funds, when you want your money back, it also means the fund manager has to get his money back. And you remember we spoke that debt instruments are not that liquid. So they have to only invest in securities that match what their customers will want to redeem at. So mutual fund, different types of debt schemes are based on investor requirements of how long they willing to wait and are prepared to stay invested.
Okay, got it. So we started with overnight funds, which are effectively investing in overnight lending needs. Then there are 7 days funds, which are
Correct.
short term
No,
funds.
ultra short. So they are
Ultra
called
short.
ultra short.
Okay, and then there are short term funds.
Yes.
They for what kind of duration
So
do they
short
work?
term goes from anywhere up to 1 year and around average of 1 year. So 6 months to 2 years is short term.
Okay, understood. But if I just draw parallel from bond, as I was asking in bond also, right? If I have something for 1 year, a bond, I might not be able to sell it before 1 year.
Correct.
But in debt mutual funds, I can because
No,
it's
because they
traded.
hold a portfolio. So at any point of time, they have say 20 bonds, some with 6 months, some with 1 year, some with 1.5 year. So if you ask for a money back early, the 6 month one will get rolled over and they'll give you the money from that. So you don't buy a single bond, you buy a scheme, you buy a portfolio.
Right.
And because of that, you have different maturities. When you buy one, then you have to wait for that one to get
Right.
matured. Here, there are always some things maturing, always some things that you're investing, and hence they're able to provide that liquidity to you.
Got it. So in a way, investing in the portfolio of bonds is helping me getting more liquidity.
More liquidity, possibly more safety, a more professional fund manager, but lower returns.
Right, got it. Perfect. And in debt mutual funds, are there certain parameters that as a retail investor I should look at?
In debt, you would always want to invest in higher interest bonds because that gives you more returns. So, a fund manager who's able to invest in higher but managing the risk is the quality of the fund manager. So, you want to invest in those schemes of fund managers who have a track record of investing in debt, not just being conservative, because it's easy to be safe but not generate any returns. So, you want them to generate returns also but have safety. So, that's a good fund manager.
Right. No, fair. And for my understanding, right, because I'm in debt mutual funds, I'll also not get the coupon payments which I get in bonds, and I'll just get the final lump sum when I sell the debt
Yeah,
mutual
so
fund.
when you invest in a debt mutual fund, the portfolio is investing in bonds.
Correct.
So the money comes back into the portfolio and that is reflected in your NAV.
Okay.
And once you you withdraw at the prevailing NAV of that point of time and you get that difference. But the growth in NAV is determined by both these, the coupon payments that are received by the bonds and any price increase that we spoke about that happens in those bonds.
Okay, understood. And debt mutual funds are also, I believe, similarly taxed.
Yes, that's right. Same as bonds. They removed any taxation advantage that did have until 2 years back. And now you are taxed at your income slab level, whether short term or long term, it's taxed at income slab level in debt mutual funds.
Got it. Understood. And you mentioned four categories of debt mutual funds here. Any framework of, recommending what is meant for who?
So you say, I want government, but I want long tenor. Then you can invest in what are called duration funds. That's
Okay.
one type of debt that invest in long duration government securities.
Okay.
You say, no, I want private, but I want short term. Then you will invest in an ultra short fund. So depending on your time horizon of investment and determining, do you want to go on the safer credit risk, what I said, right? So do you want to go on a low credit risk or do you want to go on a high credit risk? That determines your call.
Got it. Got it. Understood. Next, I would want to move to these new asset classes that are coming up in this debt ecosystem, alternates. Uh, Three of them, particularly, which are gaining a lot of traction from retail investors as well. The first being invoice bill discounting. Could you tell more on what that is exactly?
Right. So invoice discounting actually is a very old business, also known as factoring. It's a business that's been there for last 50 odd years. Essentially, what it is that say you have a merchant who manufactures certain goods and they do it on behalf of, say, a company like HUL, for example, large corporate. Now, when they raise an invoice, typically the company has a certain bill settlement cycle. So they may take the invoice today, but I'll settle it in 2 months as per my payment cycle. Now I'm a small vendor. I want my money today, but the company is paying only after 2 months or 3 months. So what do? I want my cash. So I take that invoice, which has been stamped and backed by this corporate, and I go and give it in a bank. And I tell, see, bank, this company is going to give me this money after 3 months. Can you give me some money in advance against this invoice? And after 3 months, when I get the money from the company, I will settle it with you.
Hmm.
So for the bank, it's like a lending. And the risk is whether that company is going to pay this merchant or not. So if it's a fairly large corporate, then it is not any risk. Like this could be an IT company, a top 50, Nifty 50 company, and it's a standard practice cycle because they have their own payment cycle, they have their own cash flow management, and so on. So for the bank, essentially, it is a low risk lending mechanism. For the merchant, rather than getting 100 rupees after 3 months, I am getting 98, say 97 rupees today. I'm okay with that because once I have 97, then I can do more of my production today. Effectively, what I'm doing is the bank gives out 97 today and collects 100 once the company pays the merchant. So they are earning 3 rupees in 3 months, effectively a 12% interest rate. So that is the lending model. So you can find platforms that offer this product where you, as an investor, an individual investor, can now invest in the invoices which are backed by top corporates. Now, as a concept, it is good because you're taking short term risk only. You're only taking a 3 month risk versus in bonds where you may take 1 year or it's a different, you don't take the maturity risk. And hence, here there is an attraction for such short term products. The challenge here, and of course, the risks in this kind of thing is that what if happens if the corporate doesn't pay? So, these are some risks. So, you should be careful when you invest in this product. As a concept, it is good. It's not anything new. It's a very old, but it's come into the retail investment space very newly. So that essentially is what invoice discounting is. You get decent rate. You typically get between 10 to 12% rate for a short tenor of 3 months, where your other alternates for that are probably your liquid funds or your short, ultra short funds, which give you around 7%. So that's the appeal for the investor.
Got it. Got it. And another asset class that's, becoming attractive is P2P. What's your, like, for our audience, can you explain what P2P is and what's your take on that?
Right. So P2P, as the name suggests, means peer to peer. Now, a peer could be an individual or it could be a merchant again. So you could have an individual lending to another individual. So instead of you going to a bank to borrow, you go to a person to borrow. So you think of it lending to your friend. Now you think of it at scale, where an individual lends to another via a platform. So if you invest, say, 1 lakh rupees in a P2P platform, they then distribute that into smaller chunks and they further sublend it. So essentially, it's like corporate bond where you lend to a corporate, P2P is lending to a person. It's as simple as that. It is governed by the RBI. It is a regulated product, and it has its own pluses and minuses. Again, the pro is that you get slightly higher interest rates as compared to other products like a fixed deposit and so on. But the other challenge is that if the person who's borrowed it doesn't repay, then you have the same credit risk, and again the default, which leads you to get lower returns. So the product is regulated, but you should understand what the risks are. And here, credit risk is a big risk. Yes.
Yeah. And, across these new alternate asset classes that are coming up, like, what's your view? There's a lot of regulatory things that are happening around. What's your view on the future of these new age asset classes?
Right. So one more is like asset leasing, for
Hmm.
example. That's also another product where you're essentially investing in, you have these Swiggy, Zomato riders, right? They need vehicles. So there is a person who buys a fleet and gives them the bikes to ride. They charge a rental from the delivery company, and that rental is essentially you're monetizing your asset. So the asset, and it comes to the investor of that asset. So that's asset leasing. That's also not regulated, but it's a form of borrowing that exists
Yeah.
in the market. So my view on these is that some of them are good instruments, provided you know what you're doing, where your money is going, and you should be conscious of the risk. And again, I would classify all these as debt alternates. So in the bigger scheme of things, when you create your own personal portfolio, while your main bread and butter could be mutual funds, possibly could be direct stocks, you can try out alternates because they give a good kicker to your portfolio. But you should keep it a small portion of portfolio. It should not be the entire portion because they are risky. Higher risk comes, I mean, high returns comes with higher risk. So depending on your age and risk profile, it could be anywhere between 5 to 20% of your portfolio. Should not be more than that.
Got it. Got it. Great. Perfect. I think we covered a lot. We discussed multiple asset classes within debt here. If I am a 30-year-old looking for, diversifying my portfolio into debt, what's your recommendation? Any framework that I can follow to choose the right asset class for me?
Completely depends on your risk profile. If I broadly take somebody as say aggressive, moderate, and conservative, so three different risk profiles. So an aggressive investor typically has a lot more equity, and hence aggressive investor equity could be anywhere around 70-80%. And broadly, you can think about 10 to 15% debt, maybe 5-10% alternates. If you're moderate, that 10 to 15 can go to 25-30, and if you're conservative, it could go to as high as 60-70% into debt. Now, again, in debt, there are different options. I think it depends on your further risk profile. If you are very conservative, then stick to bank fixed deposits because that is possibly the safest option that is out there. If you have the ability to take a little more risk, then you can come to corporate bonds, which is where a vast majority of the customers do exist. And if you are very high risk and you can take a lot of it in the debt space, then you can go into the high yielding bonds, high yielding or even higher, which give you 15-16%. There are some credit funds that do that. Another factor is your age, and age plays an important role because, uh, see, in investments, what happens if you lose money? How quickly can you replenish your savings and
Yeah.
your investments? So if you have a long time to work, so say if you are 30, you probably have another 30 years of work life left. But if you're planning to say retire in 5 years, then you don't have a chance. So if a market crashes, you will lose your credit default happens, you lose your money. Then recovering your savings becomes a challenge. So at a younger age, you would have heard, right? Take a lot of risks, enjoy your life, do whatever you want. I think investing is exactly the same. When you're younger, take a lot of risks. As you get older, In life, you'll start having a family, you'll start having all of that. In investments, you'll start having planning for goals, for your children, for your retirement, and so on. Then you will not be able to take so much risk and chance. And that's where debt starts playing a serious role in a user's portfolio at that point of time. Because you need to be, as we said in the start, right? In the early years, with a higher risk profile, it's about wealth creation. But towards the end, as you get closer to your goal or as you get closer to retirement, it's about wealth protection.
Yeah. Great, perfect. Thanks so much, Vijay, for sharing so many insights. I had a lovely time. Thank you so much.
Thank you. Thank you for having me, and I hope it was useful.
Perfect.